Thanks for joining us for this webinar about the proposals for a new PBE standard on financial instruments. So you'll see that there are two exposure drafts that we're going to be talking about today. Most of the proposals are actually set out in the exposure draft for PBE IPSAS 41. So that's a proposed new PBE standard. And the other exposure draft, the effective date of PBE IFRS 9, is just a short accompanying exposure draft. So your presenters today are Joanne Scott and Gali Sloosberg, and we're both with the Accounting Standards team at the External Reporting Board. So the proposals discussed in this webinar today are relevant for Tier 1 and 2 PBEs, applying PBE standards. Okay. So first of all, let's run through the contents of this webinar, what we're going to be covering today. We'll talk about why are we proposing a new standard. Then we'll give you a quick heads up on what's new and which bits you might need to focus on in the proposed new standard. Then we'll have two sections, one on moving from a standard called PBE IPSAS 29 to PBE IPSAS 41. And then, because we've got another standard that also deals with financial instruments, some entities will be moving from PBE IFRS 9 to PBE IPSAS 41. And then we'll conclude by talking about the next steps and how you can comment on the proposals. Remember, this is a recorded webinar, so you can pause and replay at any stage. If you've early adopted PBE IFRS 9, you can choose to listen to the whole webinar, or you could look at the next few slides and then skip ahead to slide 23. And if you're still applying PBE IPSAS 29, you can choose to skip the slides dealing with PBE IFRS 9. So let's talk about why we're proposing a new standard. The main driver is simply for international alignment. We have two international standards which are already substantially aligned. So those two international standards are IFRS 9 financial instruments, and some of you will be aware that we have a standard NZ IFRS 9 that forms part of NZ IFRS for entities that are applying the for-profit standards. There's also another international standard, IPSAS 41, which is based on IFRS 9 and is substantially aligned with it. Now, in the new exposure draft that we're talking about today for PBE IPSAS 41, that standard's based on IPSAS 41, and therefore it's substantially aligned with IPSAS 41, IFRS 9 and NZ IFRS 9. So one of the key benefits from the proposals in the exposure draft of PBE IPSAS 41 is that we will be aligned with the most recent international standards, and we will also have substantial alignment between our for-profit and PBE standards. And there are advantages in that for mixed groups, obviously. As I mentioned, we currently have two standards available for application by entities applying PBE standards. We have PBE IPSAS 29, Financial Instruments Recognition and Measurement. That's been around for a while, and that was based on an earlier for-profit standard. We also have a domestic standard, PBE IFRS 9, Financial Instruments. That standard was issued as an interim measure pending the development of IPSAS 41. The NZASB wanted to try and address some immediate or some pressing mixed group issues and issued that as an interim standard. So PBE IPSAS 41 would substantially supersede PBE IPSAS 29. There will only be one section of that standard left, and Gali will talk about that later, and it would also supersede all of PBE IFRS 9. At this point, it might be worth mentioning that there are a number of publications available which talk about the requirements of IFRS 9 and their implications for entities. Because these standards, IFRS 9, IPSAS 41 and the proposed PBE IPSAS 41, because those three are so substantially aligned, you might well find some of the guidance material about IFRS 9 helpful. However, it does pay to be aware that there are some differences. So I'd suggest that if you're reading any publications about IFRS 9, you also have a marked up copy of the ED of PBE 41 close by, just so that you can refer to it and make sure that any requirements that you're reading about are actually exactly the same in PBE 41, or that you're aware of any differences. So first, the next step is to talk about what's new, and we'll talk about what's new for three different types of entities, or entities with three different types of interests. We'll talk about what's new compared to PBE 29, what's new for an entity with relatively few financial instruments, as is the case with many charities, and then what's new for entities that have already early adopted PBE 9. So the next few slides are just a quick heads up about what people in each of those groups might be interested in looking at. So for entities that are still applying PBE IPSAS 29, Financial Instruments Recognition and Measurement, there's about 4 key differences that we'll be going through today. First thing to be aware of is that with financial assets, there's a new classification and measurement model, and Gali will take you through those requirements in a further section in the webinar. But that's a substantial change. Impairment, there's a new expected credit loss model, which is more forward-looking than the current incurred loss model. So again, entities that are currently applying PBE IPSAS 29 will need to be aware of those new requirements and what they might mean for them. Hedge accounting, not all of you will be engaged in hedge accounting, but if you do hedge accounting, or you're thinking of doing it, then you'll be interested in knowing that there are new, more flexible requirements set out in the proposed new standard. There are also some additional disclosure requirements that form part of the proposals, and they're set out in the consequential amendments at the back of the exposure draft. So some of those amendments, some of those proposed changes to the disclosure requirements are to align with the new requirements, but also there are substantial new disclosure proposals about impairment and hedge accounting. Now, I'm aware that some of our listeners today will be saying, hey, this standard, it looks pretty big. It looks like there's a lot of changes. You know, I'm a bit concerned. How much do I need to know about this? What will it really mean for me? Because some entities don't have many financial instruments or have relatively few types of financial instruments. So we've headed up this slide, what's new for charities, but it's equally applicable for other entities that have got relatively few financial instruments.
On that topic, Joanne, there would be some charities and potentially other PBEs whose only financial instruments are cash, receivables, payables, and potentially some bank deposits. For such an entity, what would change under the proposed new standard, if anything?
Well, for quite a few of those financial instruments, classification and measurement are likely to remain at amortised cost. So entities will still need to check that they qualify to account for those instruments at amortised cost, but in many cases that will be the case. But even if they remain at amortised cost, they will need to reassess impairment in accordance with the new impairment requirements.
And what about concessionary loans? Would there be any changes for PBEs who have granted concessionary loans?
Yeah, there could be some changes. So concessionary loans are where an entity grants loans at below market terms to another entity. And in some cases, those below market terms are just low interest rates or zero interest rates. And if it's just a low interest rate, then classification and measurement, you might still remain, say, at amortised cost. But if you have different types of concessions, for example, if repayment is dependent upon the circumstances of the recipient at a point in time, then you would need to go through and look at the new classification and measurement requirements to check which category you fall into. And for any concessionary loans, say that you're accounting for at amortised cost, you would also need to step through the new impairment requirements. And if you are an entity that grants concessionary loans, I'd suggest that you actually search through the document, just put in concessionary loans, and you'll skip ahead to the sections that deal with them, and just have a read through those, because there's a lot that's the same. You still have to identify the concession and figure out what it relates to and account for it as a concession, but the requirements have been aligned so that they fit within the new standard. So there's some paragraphs that look pretty much the same as the existing standard, but you should read through those sections and check them.
Thanks, Joanne. And what if a charity has investments in bonds and notes?
That one's a little bit tricky, Agali. An entity might need to reassess classification and measurement. So that's a have a look and check it out answer, really. And again, if it's in a category that needs to be considered for impairment, you would need to consider the new impairment requirements. So I hope that's put some of our listeners' minds at ease, that they may get away with some of their financial instruments remaining at amortised cost if that's what they're currently using, but they will just need to check it out. And we're aware that some entities, such as entities that are within the government reporting entity, have already early adopted PBFRS 9. So if you're one of those entities, what do you need to know? Well, we've got a separate section on this at the end of the webinar, but just as a heads up, you could say, well, there's more. What is there more of? It's more up to date. It's more aligned with the most recent international standards. So PBFRS 9 was issued as an interim measure, and it didn't pick up all of the changes that had been made to those international standards in recent years. This is more, the new proposals are more comprehensive. There's a few more PBE specific modifications, and we've created a marked up exposure draft with shading to highlight some of those things for you. There's a couple of sections where there's some new disclosures being added to the disclosure standard, PBE, the Financial Instruments Disclosures, PBE IPSAS 30. And there are more examples and guidance. So there were no illustrative examples or illustrative guidance in PBFRS 9, whereas all that material is included in the ED PBE IPSAS 41. Because there are some new requirements, there are also some new transitional provisions, and really I'd encourage people to focus on those transitional provisions because they're the key bit that it's important that we get right. So we would value your feedback on those. Those are the bigger categories. There are also some detailed differences, and we'll explain later where you can find a list of those differences in the invitation to comment and the marked up exposure draft. Probably at that point I should pause and say, there I'm talking about the differences, but really if you've been applying PBFRS 9 and you're looking at this proposed new standard, many paragraphs are identical. It's virtually the same. The differences are at the margin. And we have tried to highlight those for you in the invitation to comment and the ED. So maybe if I hand over to Gali to take you through what does it mean for entities that are moving from PBE IPSAS 29 to PBE IPSAS 41.
Thank you, Joanne. So first, let's have a look at the proposed new classification and measurement model under PBE IPSAS 41. So this slide should be hopefully a familiar picture for those of you who are currently applying PBE IPSAS 29. It shows how financial assets are measured the initial recognition. So starting from the left-hand corner and going clockwise, we've got loans and receivables, which are measured at amortized cost. Then we have held to maturity financial assets, which are also measured at amortized cost. Then fair value through surplus or deficit. And then finally, financial assets that are available for sale, which are measured at fair value through other comprehensive revenue and expense. And this slide here shows the new classification and measurement model, which is proposed in PBE IPSAS 41. So under this new model, we have got amortized cost, fair value through surplus or deficit, and two categories of fair value through other comprehensive revenue and expense, one for debt instruments and one for equity instruments. Now, at this point, you might be thinking, what is the difference between the new categories and the current ones, other than just the names? Isn't amortized cost the same as loans and receivables? And isn't fair value through other comprehensive revenue and expense the same as available for sale? Well, the answer is that there are in fact some differences. First, the criteria for being classified in each of these new categories are different to those under PBE IPSAS 29. Secondly, for some of these new categories, the measurement requirements are a bit different to their PBE IPSAS 29 counterparts. Let's look into this in more detail now. So under the proposed PBE IPSAS 41, there are two classification criteria which will determine which category a financial asset will be classified as. The first criterion is the nature of the asset's contractual cash flows. We need to ask ourselves, are the cash flows arising from the asset solely payments of principal and interest? The second criterion is the management model within which the entity holds the asset. We need to ask ourselves, are we holding the asset within a model whose objective is achieved by collecting contractual cash flows, or by both collecting cash flows and selling the asset, or are we holding the asset for trading, or under some other model? And the answers to these two questions would determine in which category the financial asset is classified.
So, Dali, you've got two criteria on the slide. So what you're saying is that you need to look at those two criteria, but the classification and measurement category that you end up in for a financial instrument will depend upon the combinations. So on the one hand, there'll be solely payments of principal and interest, yes or no, that's one option. And on the other side, you've got various management models. So you've got a few combinations.
That's right, there are a few combinations, and let's have a look now at what those different combinations look like. So first, let's have a look at the possible combinations and what categories they lead to for debt instruments. So here we're talking about instruments like receivables, deposits, loans to other entities, and bonds. So looking at this table, in the first column, you have the first criterion that we mentioned, which is whether the contractual cash flows from the asset are solely payments of principal and interest or not. In the second column, we have different possible management models. And in the third column, we have the classification categories into which an asset falls as a result of these different combinations in the first and second column. For example, looking at the first line, if the nature of the asset's contractual cash flows is solely payments of principal and interest, and the asset is held to collect contractual cash flows, then the asset would be classified as amortized cost. I will pause for a minute now for you to have a look at the rest of the combinations of the two criteria and the classifications that they lead to. I will mention though that, as you can see from the first column, if the nature of the contractual cash flows are solely payments of principal and interest, then the category in which you land depends on the management model. But if the contractual cash flows are not solely payments of principal and interest, then the asset needs to be classified as fair value through surplus or deficit. I should also mention that there is an option to designate an asset as fair value through surplus or deficit, even if the classification criteria lead to another category. But this can only be done with an accounting mismatch. Now, what I mean by an accounting mismatch is that it's something that happens when there is a measurement or recognition inconsistency that arises from measuring assets or liabilities on different bases, or recognizing the gains and losses on these assets on different bases. Now, we won't go into accounting mismatch in detail at this point, but if you think this is something that applies to you, then there is more information in the proposed new standard.
So Gali, there's a lot of information on this slide, and it's one that people that aren't familiar with the new proposals might like to take some time looking at. And really what you're saying is that in the first column, it's about the criterion about solely payments of principal and interest, and it's a yes or no answer to that question in that column. And then you've got those various management models, so the combinations will lead you into the classifications. And really, those classifications and measurement requirements in that right-hand column, they're really the similar accounting techniques to what people would be currently using to measure financial instruments. Broadly similar, aren't they?
That's right, yeah, they are broadly similar.
But in some cases, some slight differences.
Yeah, that's right. Sometimes in the way in which you get into these categories, in terms of the criteria that you have to satisfy, and in some cases there are slight differences in measurement.
Yeah. Thanks for that, Gali.
So now let's have a look at a few financial assets that would be common among PBEs, and what categories they're likely to fall into under the proposed new standard. So first, let's look at receivables, and we're talking about receivables from both exchange and non-exchange transactions that arise under PBE IPSAS 9 and PBE IPSAS 23. So receivables would normally meet the solely payments of principal and interest test, because what a PBE would be entitled to is the principal amount of the receivable, and interest, even though that interest may well be zero and would be zero for a lot of short-term receivables. Also, receivables are generally held to collect contractual cash flows rather than under a different model. So because of these two, I guess the answers to these two criteria, receivables are likely to be classified as amortized cost under the proposed new standard, as they are under the current requirements. The same applies to deposits, and it's also likely to apply to loans to other entities, including concessionary loans, except that, as Joanne mentioned earlier, concessionary loans might need special attention here in terms of looking at what exactly is the nature of the concession, because some types of concession around repayment terms could cause the loan to fail the solely payments of principal and interest test, which could lead to classification as fair value through surplus or deficit. Now, if a PBE has bonds, you would need to think carefully about the terms of the bond and how you manage the bond. So a plain vanilla bond that pays interest coupons on specified dates and then the bond principal maturity would likely meet the solely payments of principal and interest test. And if you hold this bond and other like it to collect these interest coupons and the principal, then you'll be holding it to collect contractual cash flows. So because you meet the solely payments of principal and interest test and you're holding the bonds to collect contractual cash flows, the bond would be classified as amortized cost. Other bonds, for example, bonds that are more complex or bonds that are held under other management models, are likely to fall into the fair value through other surplus or deficit category. It is possible for a bond and potentially for other assets to fall into the category of fair value through other comprehensive revenue and expense, but this is expected to be rather uncommon for PBEs. It's also worth noting that unlike the available for sale category in the current requirements, under PBE IPSAS 41, classification as fair value through other comprehensive revenue and expense is not an election for debt instruments. It either applies or it doesn't apply. So if you currently classify bonds or other debt instruments as available for sale, you may need to reassess your classification and measurement for these instruments.
So what I'm taking from this slide, Gali, is that for these common types of debt instruments, which PBEs most will have receivables, some might have deposits, some might have loans to others, some might have bonds. For these common types of debt instruments, an awful lot of them might end up being classified as amortized cost, which might be no change from their current accounting methods, but they will need to check.
That's right.
Yeah.
Yes.
So you may end up in a similar place in terms of how you classify and measure these types of debt instruments, but you'll have to go through a checking exercise to make sure that's correct.
Yes, that's exactly right. Thanks, Joanne. So we have looked at financial assets that are debt instruments. Now let's look at the classification of assets which are equity instruments, like shares in other companies. And this is probably not something that is as common as debt instruments are for PBEs, but some PBEs would probably hold shares. So let's have a look at this type of asset. If you're holding shares for trading, then you would continue to classify and measure these shares as fair value through surplus or deficit. If you're not holding shares for trading, for example, you're holding them as a long-term investment or as a strategic investment, then you can classify them as fair value through surplus or deficit, or you can elect to classify them as fair value through other comprehensive revenue and expense. Now, this sounds similar to the choice that you currently have under PBE IPSAS 29 to classify shares as available for sale, but there is actually a difference there. If you classify shares as fair value through other comprehensive revenue and expense under the proposed new standard, all fair value movements go through other comprehensive revenue and expense and stay in assets or equity, even when the shares are sold, which is different to available for sale, which, for example, in some certain circumstances would require impairment to be recognized in surplus or deficit. There is also a difference between fair value through other comprehensive revenue and expense for equity instruments and fair value through other comprehensive revenue and expense for debt instruments. For example, for fair value through other comprehensive revenue and expense for debt instruments, there is in fact a requirement to recognize impairment through surplus or deficit, whereas for equity instruments, there is no such requirement. So if you're going to classify shares or other equity instruments as fair value through other comprehensive revenue and expense, I would suggest that you have a look at the requirement for this classification in the proposed new standard.
So would it be fair to say, Garlene, now that you've run through the new classification requirements for financial assets, that if you've got debt instruments, maybe not much will change in terms of measurement, but if you've got equity instruments or derivatives, you do need to have a look at them.
Yes, that's right. And actually, just speaking of derivatives, under the proposed new standard, as long as there's no hedge accounting applied, a derivative would be measured at fair value to surplus or deficit. But if you do apply hedge accounting, then there are different requirements, and we will discuss hedge accounting a bit later in the webinar.
Don't forget it's a tab.
Sorry about that. So we have looked at the new classification and measurement model for financial assets, and just wanted to mention something quickly about financial liabilities. So compared to the changes to financial assets, PBE IPSAS 41 doesn't really change much for the classification and measurement of financial liabilities. That means that amortized cost is still the default category for financial liabilities, unless the standard requires or permits otherwise. Certain financial liabilities, like, say, derivatives in liability position, must be classified as fair value through surplus or deficit. Also, in certain circumstances, there is an option to designate a financial liability as fair value through surplus or deficit, for example, to avoid an accounting mismatch. So the classification of a PBE's financial liabilities is unlikely to change under PBE IPSAS 41. There will, however, be a change in the presentation of those financial liabilities that the PBE chooses to designate as fair value through surplus or deficit. For this type of liability, under PBE IPSAS 41, the part of the fair value movements that relates to the entity's own credit risk will need to be recognized in other comprehensive revenue and expense rather than in surplus or deficit. So that was classification and measurement. Now let's have a look at the new impairment requirements of the proposed PBE IPSAS 41.
And I think you've got about 4 slides on this, haven't you, Gali? There's a few things to consider with impairment.
That's right, that's exactly right. So as Joanne mentioned, the new impairment requirements under PBE IPSAS 41 are more forward-looking than the incurred loss model that we currently have under PBE IPSAS 29. This means that impairment would need to be recognized for expected future defaults, and these would need to be probability weighted. And for the longer term assets, they will need to be discounted to present value as well. The new impairment requirements will apply to all financial assets that are measured at amortized cost, and they will also apply to debt instruments that are measured at fair value through other comprehensive revenue expense. Now, there are 2 approaches to impairment under the proposed PBE IPSAS 41. For receivables from exchange or non-exchange transactions, entities will need to use the simplified approach to impairment. This means that you would always recognize impairment based on the lifetime expected credit losses for that asset. There is also an option to apply the simplified approach to lease receivables. For all other financial assets that are subject to the impairment requirements, like most loans, deposits, and some bonds, you would need to apply the general approach to impairment. Under this approach, you would need to keep track of the credit risk of the asset. As long as there was no significant deterioration in the asset's credit risk since it was acquired, you would recognize impairment based on the 12 months expected credit losses. But if credit risk has deteriorated significantly since the asset was acquired, impairment would need to be recognized for the lifetime expected credit losses. As you can see, the simplified approach is simpler because it doesn't require you to keep track of the asset's credit risk.
So Gali, we've got the simplified approach and the general approach. I know that sometimes people talk about the general approach as being the 3-bucket model, but you've kind of got 2 categories here. So where does the 3rd bucket show on that slide?
That's a good question. So in the 3-bucket model, which you might have seen in publications, in the 3-bucket model of the general approach, the first bucket corresponds to the scenario where there was no significant deterioration in the credit risk, which is when we would recognize impairment based on 12 months expected credit loss. When credit risk deteriorated significantly, there are 2 possible scenarios. One is that despite the deterioration in the credit risk, the asset is not yet credit impaired because a loss event has not occurred yet. And that would be the 2nd bucket of the 3-bucket model. The other scenario is that the loss event has occurred and the asset has become credit impaired. For example, the debtor has gone into liquidation or other financial difficulties. And that would be the 3rd bucket in the 3-bucket model. In both the 2nd and 3rd buckets, impairment is measured based on the lifetime expected credit losses, but there is a difference in how the interest income on the asset is calculated.
So really those 2 boxes that are showing on the bottom right-hand corner of that slide, the first box is the 1st bucket, and the far right, the last box on that diagram, that could be split into 2 buckets depending upon the circumstances.
That's right.
Okay. But I'm sure that some of you are interested in learning more about the simplified approach and hoping that you qualify for it.
Yes, and there is a practical expedient, which should hopefully be good news and make life easier for PBs when impairing receivables. So in PBE IPSAS 41, there is a practical expedient that allows using a provisioning matrix to determine the impairment of receivables. And the table at the bottom of the slide shows what a provision matrix might look like. So to use a provisioning matrix, you would need to first group your receivables in a way that reflects credit risk. This could be done using age buckets, and depending on how diverse your receivables are, you might need to further segment them into, for example, by type of customer or by type of service, if this affects credit risk. And then once you've grouped your receivables, you would then need to determine the loss rate to apply to each group. And the loss rate would be based on your historical defaults, but it will also need to be adjusted for current and future forecast information. For example, say for a certain age bucket of your receivables, you've had a historic 3% default rate. But if you're expecting an economic downturn in the future, you would need to adjust this expected rate of 3% upwards to reflect this expected forecast information. So if we quickly look at the example, the table on the slide, in the first column, you've got your groupings of your receivables. So we've done it by age. In the second column, we've got the expected credit loss rate, which would reflect historical experience as well as future forecast information. In the third column, we've got the gross receivable amounts in each age bucket. And then in the fourth column, we have the result of multiplying the expected credit loss rate by the gross receivable in each bucket. And there at the bottom, we get our impairment allowance for the receivables.
So, Gali, compared to what some entities are currently doing, let's say they currently use some type of matrix like this to identify impairment, the main difference is that in that expected credit loss rate column, that second column, they might need to adjust those rates to take account of their future forecasts.
That's right. It's important to take into account the future forecast, although the historic rate would still be the base for the loss rate.
So I guess the good news there is that there may be some adjustments required, but in terms of the way that you're grouping and looking for impairment, it may not be that much different compared to what you currently do.
So we're looking at the expected impact of the proposed new requirements on impairment. Some financial assets might be impaired earlier than the PBE IPSAS 29 because the proposed new model is more forward-looking and looks at expected credit losses rather than just incurred ones. Also because of this, this more forward-looking element, management would need to make more judgments about future events. It's also possible that PBEs will need to upgrade their systems and processes to be able to gather additional information if they're not currently gathering this information. For example, keeping track of historic losses and also keeping track of forecast future information that relates to different groupings of receivables, for example. There will also be additional disclosure requirements, and these are located in the proposed consequential amendments to PBE IPSAS 30, and there will be some RDR concessions for Tier 2 PBEs. And one thing to bear in mind is that the size of the impact, the magnitude of the impact of this proposed new model on a PBE would depend on the type of assets that the PBE has and also your past experience of losses and future expectations, as well as your current accounting policy regarding impairment. So we've looked at classification and measurement of financial assets. We've looked at impairment of financial assets. And now let's have a look at something else that the proposed new standard will change, which is hedge accounting. So PBE IPSAS 41 introduces a new hedge accounting model, which is which is aimed to better reflect a PBE's risk management activities in its financial statements. So the proposed new model is less restrictive than the current model in the PBE IPSAS 29. Under the proposed new hedge accounting requirements in PBE IPSAS 41, there will be more risk management strategies that would qualify for hedge accounting. Also, you may be aware that under the current hedge accounting requirements, you need to achieve and maintain hedge effectiveness of between 80 and 125% to be able to apply hedge accounting. But in the proposed new hedge accounting model, there is no such bright line effectiveness threshold. Having said that, if you prefer to continue applying current hedge accounting requirements of PBE IPSAS 29 instead of the new requirements of PBE IPSAS 41, you are allowed to do so. This option is allowed because the International Accounting Standards Board is currently working on a project to further update hedge accounting requirements.
Gali, that's a little bit unusual, isn't it? That there's going to be an accounting option, but the option to apply the old requirements, those old requirements are going to remain in the old standard. So that's going to be the only part of PBE IPSAS 29 that remains once the new standard is introduced.
That's right. So as you mentioned before, PBE IPSAS 41 will supersede most of PBE IPSAS 29, but yes, those hedge accounting requirements will still stay within that standard. So I mentioned that there is no longer a requirement to maintain hedge effectiveness between 80 and 125% to qualify for hedge accounting, but what would an entity actually need to what criteria an entity would actually need to meet to qualify for hedge accounting under the proposed new model? Let's look at those. So firstly, there needs to be a formal documentation of the hedge relationship, including what is the hedged item, what is the hedging instrument, what risk is being hedged, etc. There will also need to be an economic relationship between the hedging instrument and the hedged item. So this means that the hedged item and the hedging instrument need to move in opposite directions in response to a change in the hedged risk. For example, say you're using a forward foreign exchange contract to hedge against foreign currency fluctuations in the value of a long-term receivable in, say, Australian dollars. So as the New Zealand dollar strengthens against the Australian dollar, the fair value of the forward contract would decrease and the value of the receivable would increase. And so the fact that these two move together in opposite direction in response to the change in the exchange rate indicates that there is an economic relationship between them. Also, the other criteria is that the fair value movements within the hedge relationship must not be dominated by credit risk. And lastly, the ratio between the quantity of the hedged item and the hedging instrument for hedge accounting purposes, which is known as the hedge ratio, must be the same as the ratio between the quantity of the hedged item and hedging instrument that's actually used for risk management purposes. So these are the classification criteria. And once you have applied these criteria and you've met these criteria and you choose to apply hedge accounting, the mechanics of hedge accounting are actually similar to those under PBE IPSAS 29. So there are still three types of hedges: cash flow hedge, fair value hedge, and hedge of net investment. And the requirements of how to account for these hedges have not changed. However, PBE IPSAS 41 does introduce additional disclosure requirements on hedge accounting. And there are a few RDR concessions for Tier 2 PBE. And again, the best place to look for, at those is the consequential proposed amendments to PBE IPSAS 30.
Yeah. So on this slide, Gali, you've been through the criteria to qualify for the new hedge accounting requirements in PBE IPSAS 41. And so there are criteria, but what you're saying is that those criteria are less restrictive than the current requirements in PBE IPSAS 29.
That's right. So it should be easier to qualify for hedge accounting under the proposed new requirements.
Yeah. So entities that are already hedging might choose to continue using the requirements in PBE IPSAS 29 if they currently qualify for them, but alternatively it might be a good time to check out the new model.
That's right. So one question that you might be asking yourselves is, well, it might be easier to apply hedge accounting under PBE IPSAS 41, but why would I want to apply hedge accounting in the first place? So this is just a brief reminder. So hedge accounting allows entities to reflect the effect of their risk management strategies in their financial statements. For example, say you have an upcoming highly probable transaction in Australian dollars. Maybe you're going to buy a piece of equipment from a company in Australia. Between now and the time when you purchase the equipment, the New Zealand dollar to Australian dollar exchange rate could fluctuate, which means that the amount that you will end up paying is uncertain. To mitigate this risk of currency fluctuations, say you take out a forward foreign exchange contract with a bank, and this would effectively lock in a specific New Zealand dollar to Australian dollar exchange rate for your equipment purchase. But between the time when you purchased this, or you took out this forward contract, and the time when you purchased the equipment, the fair value of the forward contract itself may fluctuate. And without hedge accounting, you would need to recognize these fair value gains and losses on the forward contract in your surplus or deficit, which could cause volatility in net surplus or net deficit. And this is where hedge accounting could be quite useful. For example, if you designate the forward contract and the highly probable forecast purchase as a cash flow hedge, then the fair value movements on the forward contract, or rather the effective portion of these fair value movements, will be recognized in other comprehensive revenue and expense rather than in surplus or deficit, which would avoid or at least reduce volatility in net surplus or net deficit. And this would be consistent with your risk management strategy, which was to avoid the effect of foreign exchange fluctuations. And just to remind that the ability to, this example assumes that all the criteria that we've mentioned before have been met for applying hedge accounting. And there are other situations where hedge accounting could be applied. For example, if you have a loan with a floating interest rate and you have taken out an interest rate swap to mitigate against variability in interest rate payments, you could apply hedge accounting to the swap and the loan. And then PBE IPSAS 41 makes it easier for these risk management activities and others to qualify for hedge accounting.
Thanks for that, Gali. And I'm guessing people might now be interested in, with these new requirements, how do they deal with the transition?
Yes, that's right. That's a very good question. So PBE IPSAS 41 is proposed to become effective for periods beginning on 1 January 2022. An early application is allowed. Now, generally, retrospective application is required, which means that new requirements or changes in requirements will need to be applied to previous accounting periods. There are some exceptions to that, and the main one is hedge accounting, which is required to be applied prospectively. But even though retrospective application is generally required, restatement of comparatives is actually not required. And in fact, restatement is only allowed if it can be done without the use of hindsight. So if comparatives are not restated, which they don't have to be, any adjustments from retrospective application are recognized in the opening accumulated comprehensive revenue and expense of the year of initial application. So for example, for a June year end, any adjustments resulting from retrospective application would go through the opening accumulated comprehensive revenue and expense as at the 1st of July 2022. So that was all about the transition from PBE IPSAS 29 to PBE IPSAS 41. And Joanne, would you like to take us through the differences between PBE IFRS 9 and the PBE IPSAS 41 for those entities who early adopted PBE IFRS 9?
Thanks, Carly. So I guess we're interesting a different group of listeners at this point. So entities that have early adopted PBFRS 9 will want to know what the differences are. And as I mentioned earlier, in many cases, there are no differences or virtually no differences. So here we're focusing on what's different at the margin. So as I mentioned, PBE IFRS, what's different compared to PBE IFRS 9? Well, the new proposals are more up to date. That is, they incorporate more of the narrow scope amendments that have been made to the financial instrument standards in recent years. For example, they include newer requirements about offsetting of financial instruments and the related disclosures. They include some newer disclosures about transfers of financial assets. And then the next two bullet points are about some quite recent ones that have been introduced in the International For-Profit Standards and are going to be incorporated in the International Public Sector Standard, and they're to do with financial assets that have the possibility of prepayment features with negative compensation, which I don't think would affect many entities, but if you think you fall in that category, check it out. And also some clarifications about which standard you apply when you're accounting for long-term interests in associates and joint ventures. As I mentioned earlier, PBE IPSAS 41 includes illustrative examples and guidance. A lot of those are virtually identical to what's in the illustrative examples and guidance that accompany IFRS 9, but the International Public Sector Accounting Standards Board has also developed some additional examples and guidance. And if you are using the marked up copy of the ED, we've included some commentary, some notes for you so that you can keep track of where those things have come from. Impairment of receivables, what's different there compared to PBFRS 9 is that the simplified approach is mandated in some instances, so just check out those requirements. And RDR concessions, there are a few differences. The proposals in PBIPSAS 41 for the disclosure requirements and PBIPSAS 30, being the big disclosure standard, they've been aligned with NZIFRS 7, whereas the RDR concessions that were set out in the appendix to PBFRS 9 were aligned with some other proposals that were under consideration at that time. So there's not a lot of differences, but there are one or two. In addition, there are quite a lot of really detailed differences, some of which are just wording differences, new sentences, the odd new paragraph. And to make life easier for you, we have listed all of those differences at the back of the invitation to comment in an appendix. So you might want to go through that and check out each of those differences. We have also identified those differences in the marked up version of the ED. So they're indicated with the use of shading and comment boxes. You'll also be interested in the transition because where you've got new requirements, then you have to think about transition. The overarching requirement is that classification and measurement remains the same unless PBIPSAS 41 requires or permits otherwise. Where the requirements differ, we've drafted specific transitional provisions, and I've got some examples of those here. There's some about to deal with the prepayments with negative compensation, how you'd apply that. There's some about offsetting and the disclosures, and some about the disclosures on transferred assets. And as you can see there, they're slightly different. Some of them are applied retrospectively, but there's no restatement. Some apply to current and prior periods, but only back to the point that you adopted PBFRS 9, and some are required only from the current period. They're all set out in a single section in the ED, and if you look at the marked up ED, it's shaded. So I'd suggest that you go through those, and we would really appreciate your feedback on those requirements. The other thing is with hedge accounting, what does that mean if you've been applying PBFRS 9? The question is, has the entity applied the new hedge accounting requirements in PBFRS 9? If the answer is yes, then you continue to apply the new requirements, although they're now the new requirements that are set out in PBIPSAS 41. So if you've picked up the new requirements, you stick with them for your existing hedge relationships. If you haven't already picked up the hedge accounting requirements, you do have the option of doing so at this point. So you can pick up the new requirements or continue to apply the old ones. Remember I mentioned that there was another short exposure draft out there as well. That's about the deferral of the effective date of PBFRS 9. Why have we put that out? Well, it's to do with the dates. So if you look, PBIPSAS 41, the proposed effective date for that is 1 January 2022, but the effective date of PBFRS 9 is currently 1 January 2021, and there's a 1-year problem there. So what we're proposing to do in that short exposure draft is to defer the effective date of PBFRS 9 by 1 year so that it doesn't become mandatorily effective before PBIPSAS 41. There would still be a 6-month period after the issue of PBIPSAS 41 in which you could pick up PBFRS 9 if you were already well down the track of picking it up, but that will only be, the proposal is that that's only for a 6-month period. So those proposals are set out in a very short separate ED. So next steps, well, the main next step is that we'd like to hear from you what you think about the proposals and in particular what you think about transition. So here I'll just run through the documents on the website. There's an in-summary document that's a good place to start. It's only a few pages long. There's an invitation to comment that I'd strongly recommend that you read, and it's set out in a similar manner to this webinar and looks at the implications for both groups of entities. We've got the 2 EDs, and there is a marked up copy of PBE IPSAS 41, which many of you will be interested in. And also, just in case you want it, there's a copy of IPSAS 41. You might be interested in the IPSASB's basis for conclusions on some of its requirements. And you can see the email address there for your comments. Comments are due by 28 February, and that's the email address to send them to. So all that information is on the website. You might have also spotted the sun umbrella, because I'm hoping that at the stage that you're listening to this webinar, that you're either about to go on a relaxing break or that you've had a relaxing break and that the weather's been half pie decent for you. Okay. So where do you find all these documents? That information is set out on our Accounting Standards and Development section on the website, and those EDs are listed and they're set out together on the single page. Okay. So thank you very much for your time today.